Most people think banks make money in one simple way. They take your deposits and lend that money out at a higher interest rate. That's true, but it's only part of the story. Modern US banks generate revenue from multiple streams. Some are straightforward and visible, others operate in the background of the financial system. Together, these revenue sources form the core of how banks stay profitable, manage risk, and scale. These are the primary ways U.S. banks actually make money. The first and most important source of revenue is loan interest. Banks accept deposits from customers and transform those deposits into loans. Mortgages, auto loans, personal loans, and business credit all generate interest income. The difference between what a bank pays depositors and what it earns from borrowers is called the net interest margin. For example, if a bank pays 1% on savings accounts but earns 6% on mortgages, that spread becomes income after operating costs and loan losses are accounted for. For most traditional banks, this lending model remains the backbone of profitability. When interest rates rise, net interest margins often expand, which is why rate cycles matter so much to bank earnings. Closely related but distinct is credit card interest. Credit cards are unsecured loans, meaning they are not backed by collateral like a house or a car. Because of that, interest rates are significantly higher, often between 18 and 30% annually. When customers carry balances, instead of paying in full each month, banks earn revolving interest income. Credit card portfolios can be extremely profitable, especially during periods of strong consumer spending. However, they also carry higher default risk, which banks must manage carefully. Another major source of revenue comes from deposit spread and interest earned on reserves. Banks do not keep all deposits idle. They invest in safe assets such as treasury securities or hold reserves at the Federal Reserve, which may earn interest. When the Federal Reserve raises interest rates, banks can earn more on these assets, often faster than they increase rates paid to depositors. This gap between what banks earn on safe assets and what they pay on deposits can generate billions in income for large institutions, especially in higher rate environments. Then there are interchange fees. Every time a customer uses a debit or credit card, the merchant pays a small processing fee. That fee is split between the payment network, the acquiring bank, and the issuing bank. The issuing bank, the one that provided the card, receives a portion known as interchange, while each transaction may generate only a small amount. The sheer volume of daily transactions makes this a significant and recurring revenue stream. Importantly, banks earn interchange income even when customers pay their credit card balances in full and avoid interest. Banks also earn income from account and service fees. These include monthly maintenance fees, wire transfer fees, ATM fees, foreign transaction fees, and cashier's check fees. While regulatory pressure and competition have reduced some of these charges, fee income remains a stable and predictable part of many banks' revenue models. Fees are particularly attractive because they are not tied directly to interest rate cycles. Related to that are penalty fees. Overdraft fees, late payment fees, and non-sufficient funds charges have historically contributed substantial revenue, particularly in retail banking. Although regulatory scrutiny has increased and some banks have reduced these charges, penalty fees still represent income tied to customer behavior rather than lending performance. For larger banks with investment banking divisions, advisory and underwriting fees form another major income stream. When companies issue stock through an initial public offering, sell bonds, or engage in mergers and acquisitions, investment banks structure the deals, manage the process, and distribute the securities. In return, they charge advisory and underwriting fees. These revenues can be volatile because they depend on market activity, but during strong capital markets, they can significantly boost earnings. Large institutions also generate revenue from trading and market making. Banks facilitate transactions in bonds, currencies, derivatives, and other financial instruments. They provide liquidity by standing ready to buy and sell securities, earning money from the bid-ask spread, the difference between buying and selling prices. although regulations limit speculative proprietary trading. Client driven trading activity remains a meaningful source of income for major global banks. Another steady stream of revenue comes from wealth and asset management. Banks manage money on behalf of individuals, pension funds, corporations, and institutions. They charge management fees, typically calculated as a percentage of assets under management. Because these fees are recurring and tied to client portfolios, they provide relatively stable income, particularly when markets perform well and assets grow in value. Business and merchant services represent another important category. Banks provide companies with payment processing, payroll services, treasury management, and liquidity management tools. Merchant acquiring services allow businesses to accept card payments, and banks earn fees from those transactions. Each individual fee may be small, but across thousands of businesses and millions of transactions, the revenue adds up quickly. Banks also earn income from loan origination, servicing, and securitization. When a bank originates a mortgage, it may sell that loan into the secondary market, earning a gain on sale. Even after selling the loan, the bank often retains servicing rights, meaning it continues collecting payments and managing the loan in exchange for a servicing fee. This model allows banks to generate upfront revenue while reducing long-term balance sheet risk. Finally, banks earn commissions and distribution income from financial products. They may offer insurance, retirement accounts, investment funds, or structured products and receive referral or distribution fees. While this is typically a smaller portion of revenue compared to lending or trading, it contributes to diversified income and cross-selling opportunities. When you step back and look at the full picture, banks are not single revenue businesses. They combine lending, transaction infrastructure, advisory services, asset management, market operations, and fee-based products into diversified income structures. Understanding these revenue streams gives you a clearer picture of how the U.S. banking system operates and why different banks emphasize different strategies depending on their size, regulation, and business model. This channel is about understanding the U.S. banking system piece by piece. If that's something you care about, subscribe. Thanks for watching.